Welcome everybody to Larkin Gowan's commentary on yesterday's autumn statement. I'm Gillian McGill and I'll be hosting our panel of specialists today. I'm also joined by our fabulous marketing team in the background who are taking care of technology for us. We've heard from the Office of Budget Responsibility that inflation is expected to remain higher for longer, taking until the second quarter of 2025 before it returns to the 2% levels that have been targeted. We've also heard that growth in the economy is slower than was forecast back in spring. Nevertheless, the Chancellor has managed to find some fiscal headroom to offer tax cuts, although the positive impact of these is somewhat dampened by the effect of fiscal drag across the taxes as thresholds remain frozen. It's clear from the Chancellor's speech yesterday that he is focusing HM Revenue and Customs on ensuring that we pay the right tax, to pass on the mention of resourcing HMRC further in order to enable them to continue increasing the level of inquiries that we are experiencing in our client base at the moment. After we've heard from all of our specialists, we will have time for some questions and answers. So if you do have something that you would like to ask one of us, please type that into the chat box on your screen. We've also got some interactive polls throughout today's presentation for you to participate in. Sally and Dominic, our tax partners, send their apologies for being unable to be with us today. They both have a very long-standing prior engagement that prevents them joining us. However, they should both be back with us in time for the spring budget, when we will be in touching distance of a general election, so might expect a larger and more exciting package of tax measures. The government described this as a responsible budget for growth. So let's see what our panel think. Handing over first of all to my colleague Emily Wall, who will be talking to us about personal taxes.
Good afternoon, everybody. Let's kick off then with the main highlight delivered by the Chancellor for the self-employed. From the 6th of April 2024, the Class 4 National Insurance main rate will be reduced from 9% to 8%. This is along with the abolishment of Class 2 National Insurance, which is currently set at £3.45 per week. This is relevant for individuals with profits over £12,570, and this allows them to get their national insurance credit towards their state benefits. There will still remain an option to make voluntary payments for those with profits below this threshold in order for them to continue to get their credit. As part of the government's costing for this measure, they've taken into account various behavioural responses, one of which is in relation to trading hours. We want to hear your opinion on this, so we're going to head over to a quick poll. As a result of the changes to Class 2 and 4 National Insurance announced in the budget, do you think trading hours will increase? Thank you, everybody. And the results show that actually this won't impact much in terms of trading hours. That's interesting. Thank you. Moving on. You may recall the government announced in December 2022 that making tax digital for income tax self-assessment was to be delayed until April 26 and 27. However, yesterday, various simplifications for the regime were announced. Individuals will no longer be required to submit an end-of-period statement, but instead they will be required to only submit a final declaration to prevent duplication of information. We expect this will look similar to the current tax return that we're all familiar with, so hopefully there will be no big changes. In addition, various groups will now be exempt from making tax digital, such as foster carers and individuals that cannot obtain a national insurance number. Whilst the introduction of MTD may have been delayed, implementation of new processes and systems can be time-consuming. For all of our clients and contacts, we do encourage to start considering this now so as to minimise the disruption in the future. If you have any questions or concerns regarding MTD, please get in contact with us. Our specialist team would be more than happy to support you to get ahead of the game. Another area of interest that came out of yesterday's budget was regarding the cash basis for calculating trading income. We've now been provided with an outcome regarding this consultation announced in the spring budget. The cash basis will become the default method for calculating trading income, with individuals having to opt out to switch to the accruals basis. As a result of this new default position, the turnover threshold of 150,000 will be removed. We do, however, note that the cash basis default will not apply to the types of businesses that are normally excluded from using this basis. Another welcome change, just to note there, is the extension of EIS and VCT sunset clauses that is now been moved to April 2035. Finally, we include a brief reminder of matters previously announced by the Chancellor, such as the reduction of the CGT annual exemption and the dividend allowance, and along with the abolishment of the standard rate ban for trusts. As a final note, these will all become applicable from the 6th of April 2024. Thank you. I'll now hand over to my colleague Duncan Saxby, who will discuss the changes to employment taxes.
Thank you, Emily. The Chancellor yesterday announced 6 main measures which are going to affect employment taxes. So we'll start with the first one, which is national insurance contributions. And the main measure was that Class 1 employees' national insurance contributions are going to be cut from 12% to 10% from January 2024. So the maximum saving that you're going to achieve in 23-24 tax year is £188, and the maximum saving in every year after that is £754. The Chancellor also announced that the lower earnings limit for national insurance is going to be frozen at the 23-24 level, which is 6396. The third measure under national insurance is employers' national insurance relief for veterans. This has been extended by 1 year to April 2025. So it means that there'll be no employers' national insurance up to £50,270 for the first year in which a business employs a veteran in a civilian role. We can help you with your payroll adjustments because this change in national insurance occurs from January 24. And also you perhaps need to consider how you extract profit from your company if you're a director and shareholder. Although the adjustment to national insurance isn't particularly material, but it's very important to get the profit extraction correct. I'm now going to pause while we have a poll, and we're asking you, what is the annual cost to the government of reducing national insurance contributions for employees and the self-employed? Most people have said that it's approximately 9 billion, which is correct. Thank you very much. So the second measure in the employment taxes area is national minimum wage. And here we're concerned with national living wage, national minimum wage, and apprentice wage. So from the 1st of April 2024, the national living wage is increasing to £11.44 per hour. The national minimum wage, which applies to people up to the age of 20, is increasing to £8.60 per hour, and the apprentice wage, which applies to people up to 19 or over 19 in their first year of apprenticeship, is £6.40. The next measure to confirm is the vehicle benefits. The vehicle benefits for 24-25 tax year are remaining unchanged. So just as a reminder, car benefits are calculated with rates based on CO2 emissions. Vans have a flat rate of 3,960. Car fuel multiplier is 27,800, and the van fuel charge is 757. So these rates are the same for the next tax year. We can help in areas like completing and filing forms P11D, which record benefits and expenses. We can also review whether it's better to have vans or cars. Generally, it's better to have vans. Also, electric vehicles, many companies and businesses are moving towards the provision of electric vehicles now because they offer such low benefit in kind charges. And for example, a purely electric van is a zero charge. Also, you should never forget the salary sacrifice, which is still available for the provision of electric cars. The next area is the construction industry scheme, CIS, and gross payment status. Gross payment status is available to subcontractors so that when they receive money from contractors, they don't have any tax deducted. So it's critical for the cash flow of their business. So from the 6th of April 24, HMRC will need to ensure that you are VAT compliant in order for you to get or keep gross payment status. And secondly, HMRC can cancel your gross payment status at any time where they believe there's fraud involving any taxes. The next area is off-payroll working, commonly known as IR35. So IR35 applies where a worker operates through an intermediary, usually a personal service company. And here there is a distinction between a payer, which is a small business, and a payer, which is a medium or large business. There are different responsibilities depending on the size of your business. But that's not relevant to the measure that the Chancellor announced yesterday. So from the 6th of April 24, HMRC has power to set off tax and national insurance paid by the worker and the intermediary against the PAYE liability of the deemed employer. So this addresses the potential overpayment of tax and national insurance where the worker is incorrectly categorized as self-employed. Again, we can offer a review of employment status or help you with that. We can also help you with the reporting on compliance with IR35 rules in small and medium companies. And if necessary, to correct previous errors, we can help you make a disclosure to HMRC. Moving on to enterprise management incentives, EMI. This is the best and most flexible share option scheme, and it's designed to help businesses attract and retain key employees. And it's being implemented by many employers. The government has announced that the notice to HMRC of the grant of options, which now has to be made within 92 days, is extended. So the notice to HMRC now needs to be made by the 6th of July following the tax year, bringing it into line with other returns which are required, like P11Ds and employment-related securities returns. We are able to advise on implementation of EMI schemes, also help with the valuation of shares for an EMI scheme, to register an EMI scheme with HMRC, and to complete and file the annual EMI return with HMRC. Do contact us if you need help in any of those areas. I'd like to now hand over to Sarah, my colleague, who will talk to you about company and business taxation.
Thank you very much, Duncan. There's relatively few changes to discuss on corporate taxes. It looks like the 25% rate is here to stay for now at least. So let's start with capital allowances and the full expensing allowance. Jeremy Hunt was really shouting about this relief, but in fact it's nothing new. It was introduced from April 2023 and replaces the super deduction, giving 100% relief on the purchase of new plant and machinery for companies with no spending limit. The changes announced yesterday were to make it a permanent release when it was previously due to finish in 2026. In short, it is a relief for large companies and groups who typically spend more than £1 million on plant and machinery annually. I mention £1 million because, of course, that is the limit of the annual investment allowance, or AIA. The full expensing allowance does not replace the AIA, and due to the full expensing restrictions, the AIA will likely remain the most attractive option for now at least. According to policy documents, the government will be launching a technical consultation on the wider changes to simplify the capital allowances legislation. The biggest change for company taxes is to R&D reliefs. We recently went through a whole load of changes from 1st of April 2023. So to very quickly recap, the credit under the large company RDEC scheme went up to 20%. The enhanced expenditure relief under the SME scheme went down to 86%, and a number of anti-abuse measures were introduced, including the requirement to notify HMRC of the intention to make a claim if you've not made one in the past 3 years, an additional information form to be submitted ahead of a claim stating how the company qualifies and who prepared the claim, and the recruitment of HMRC officers to inquire into claims. At Larkin Gowan, we've seen a very sharp rise in R&D inquiries synonymous with experience shared by professional bodies. It's all change again from 1st of April 2024. HMRC are going to merge the SME scheme and RDEC scheme into a new hybrid scheme for most companies. The new scheme will broadly follow the existing RDEC scheme, meaning relief is given by way of a 20% taxable credit tax at corporation tax rates, swapped to 25%, or taxed at 19% for loss-making companies. There will be some further changes to the hybrid scheme. For instance, large companies are expected to be able to claim subcontract costs, which previously they've been unable to do. To demonstrate the changes that SMEs can expect to see, I'll put some numbers up here. You'll see that the RDEC increases tax chargeable initially because they're taxable credits, but then the gross credit is deducted from the amount payable to HMRC. This is how the RDEC currently works, and we're expecting the new scheme to operate in a similar way. It looks as if the SME scheme will not be totally abolished for R&D, but rather reserved for R&D intensive companies from 1st of April 2024. A company will fit that description if its R&D expenditure will be at least 30% of total expenditure, currently 40% for 23. R&D companies which are loss-making will be able to surrender their R&D related losses for a 14.5% cash credit, which works out as roughly a maximum of 27p for every £1 spent on R&D, but could be less depending on circumstances. And then just at the bottom, a quick mention of proposed creative reliefs reform aimed at TV, films and gaming sectors to round things off. So I'm going to hand back to Gilly now to finish things up with a section on VAT.
Thank you, Sarah. So not a huge amount to mention with respect to VAT, but the real headline issue, I suppose, is that the registration threshold of £85,000 for a rolling 12-month period has remained unchanged. Now, this is despite quite a lot of lobbying, both from some parties to increase that registration threshold to somewhere over £100,000 per 12 months, but also from some economic reports which strongly suggest that reducing it quite dramatically to around maybe £20,000 to £30,000 per 12 months would actually be a growth measure for the economy. So we've kept the registration threshold stuck at 85,000. It's another example of one of those frozen thresholds that bring more of us into paying tax due to the effects of fiscal drag. One of the measures that we did get mentioned on the VAT front was with respect to property changes. Now, this is all part of the government's real push to increase environmental measures and improve the housing stock in the United Kingdom. Currently, we have VAT relief at the zero rate on a number of energy-saving materials that get retrofitted into residential dwellings. They're specifically listed out in the legislation, and they include things like insulation, solar panels, air source heat pumps, wind turbines, etc. We had yesterday an announcement that this zero rating, which goes up until the 31st of March 2027, will be extended to also include water source heat pumps, but perhaps more notably, that also relevant charitable purpose buildings will also be able to retrofit these sorts of energy saving materials and benefit from the zero rate VAT relief. Why is that so important? Well, relevant charitable purpose buildings are usually those that are operated for non-business activities by charities, so the VAT that they would otherwise have incurred on putting these energy saving materials into their buildings would have been a cost to that charity. This relief is a very welcome one. Not a VAT specific measure, but the extension of permitted development rights to allow people to convert what's currently a single house into 2 flats. It's worth mentioning that there should be VAT relief for that kind of conversion work, whereby the 5%, the reduced rate of VAT, should be charged on the works to perform that conversion, provided that the relevant conditions are met. That's again important because if you then plan to let out the flats that result from your conversion, you wouldn't be able to recover the VAT that you incurred on the works. So any reduction from the standard rate is very welcome. We have had a well-trailed change to the VAT DIY scheme. That's now been confirmed to take effect from the 5th of December 2023. Primarily, that's going to extend the time limit for submission of DIY claims from the 3 months to a 6-month limit, which is very helpful because they take a long time to collate and they're often a very time-consuming process. In addition, part of the Making Tax Digital programme, HMRC are going to move to digitisation of DIY claims. At the moment, we have to submit ring binders full of original paper invoices, so a digital approach is again very welcome. Time now for another poll. At what point does the time limit for a DIY claim start? There we go. So it is correctly when the property is considered to be complete. Well done those who answered that correctly. It's not when you have got planning permission. That would be a complete nightmare to administer. Some other little VAT points to mention. The extension of zero rate reliefing, which was introduced a few years ago for women's sanitary products, will now be extended to reusable period underwear with effect from the 1st of January 2024. So quite a quick turnaround if that impacts you to get your systems updated and change the VAT liability for your reporting. What will be interesting to see is whether retailers pass on that saving to consumers, because experience indicates that actually these sorts of changes where zero rating is put onto products actually just result in an increased profit margin for retailers, but time will tell. Manufacturers of those sorts of products may find themselves moving from a VAT payment position to starting to submit VAT repayment returns. Those are very likely to end up being subject to HMRC compliance checks, so do be prepared if you might be in that space. Duncan's already mentioned the CIS changes and the fact that VAT compliance is going to be part of that test for gross payment status. Worth mentioning that this is affecting a sector that's still getting to grips completely with the introduction of the domestic reverse charge for construction services. And we are seeing that HMRC's previous light touch approach to those changes on the domestic reverse charge is no longer being applied, and inquiries and assessments are starting to be raised. Following Uber's VAT settlement with HMRC back in October 2022, we are expecting to see a consultation being issued on the thorny issue of when a business is acting as a principal versus when it's acting as an agent. So those of us that work in the VAT world will be well used to dealing with this issue. It comes to light in lots of different sectors, and we would really welcome some clear guidance on the matter. Furthermore, there's an indication that the private hire vehicle sector will push for a zero rating relief for their activities. Again, whether that will be passed on to the consumer remains to be seen if it does take effect. And finally, I should mention that the extension for rates relief has been confirmed for eligible retail, hospitality and leisure properties. This is going to give 230,000 businesses support in these very fragile sectors. So that concludes the sessions of the formal part of our presentation. We're now going to invite our specialists back on camera to address some of the questions that you have raised. So the first one, I think, is a question for Duncan, for you. We have got a company that is a husband and wife owned company, turnover approximately £350,000 and employing 12 employees, including themselves. And they're asking fundamentally, how is this budget helping us and how is it hurting us?
Thank you, Gilly. Yes, well, I think there's 3 points you need to consider with this. Firstly, there's the national insurance reduction for employees and reconfiguring your payroll software to accommodate that from January 24. And obviously your employees are going to have more net pay as a result, which is great. Secondly, the national living wage and the national minimum wage. The national living wage is going to rise by £1 per hour per employee. So if that's relevant to you, you need to take that into account. Thirdly, there's extracting profits from your company. It's your company, you're the directors and the shareholders. So that might be another issue. It probably isn't materially impacted by the reduction in national insurance, but it's certainly an area you need to review every year as part of your tax planning.
Okay. And potentially, I suppose that extension of the rates relief might also be relevant for that business as well, potentially. Thank you, Duncan. A question for Emily, if I may. As a result of the removal of the standard rate ban for trusts, will trusts still be entitled to 50% of the annual exemption for their capital gains?
Thanks, Gilly. Yes, absolutely. So there's been no announcements to change this at all. So for the 23-24 tax year, trusts will be entitled to an annual exemption of £1,500.
Duncan, another one for you, inevitable, I guess, with NIC being the headline issue. If I earn £30,000 per annum, what will I save in employee Class 1 national insurance contributions during the 2024-25 tax year?
Thank you, Gilly. Well, you're going to save £348 per annum. And that's because you're on £30,000 a year. And if we ignore the first £12,570, which is the primary threshold, then the balance is going to be charged to NIC at 10% rather than 12%. And that brings us to the £348 of saving.
Lovely, thank you. A little VAT question. Does the VAT DIY scheme apply to new builds only? No, there is also the ability to make a DIY claim if you are converting a property, say classically from a barn to a residential dwelling. A claim can still be submitted. Important to note, you still do need to meet all of the same conditions. So primarily that you or a member of your family then need to occupy the residential property that results from the construction or the conversion. And really key, that HMRC will only permit a claim if the VAT that you have been charged and are therefore claiming has been correctly charged. And that's the bit that does tend to catch a lot of claims out. So really important to make sure that you're correct there. Possibly last question, another one, sorry Duncan, for you. If I am a basic rate taxpayer, what tax would I pay on a van benefit and van fuel benefit for the next tax year?
Thank you, Gilly. The answer is £943 per year, and that is arrived at by taking the van benefit, which is a flat rate benefit of £3,960, and adding the van fuel benefit, also a flat rate sum of £757, and together charging that at 20%, which is the basic rate, and you arrive at £943.
Brilliant, thank you very much. I think that's the end of our questions. Of course, please do get in touch with Larkin Gowan if there's anything else that you would like to ask one of the speakers today or somebody else with the Larkin Gowan firm. Just to confirm that copies of slides will be sent out, as well as a recording of this webinar, to everybody who's signed up and then placed on our website. Thank you to all of my speakers today, and to all of you, thank you.